Welcome to V8 lesson. From this chapter onwards, we are going to focus on macroeconomics study. Macroeconomics studies the whole economy phenomena, such as economic growth, inflation, and unemployment. On the other hand, microeconomics examines how households and firms make decisions and how they interact in markets. One of the macroeconomics focuses is national income. It is an aggregate income earned by all factors of production. The bigger the national income in a country, the more income its individual inhabitants will be earning on average. National income statistics are useful to measure economic growth rate of a country that helps government in economic planning. Movement of national income can be explained by using a two-sector circular flow model. This model shows how goods, services, and money move between households and firms. The model assumes that an economy has only two sectors, namely households and firms. Households are product consumers as well as owners for the factors of production. Firms produce only finished goods for sale. There is no saving by either households or firms. That means households and firms spend all of their incomes. Besides that, there is no taxation and no government spending. Therefore, all incomes received by households and firms are available for spending. Lastly, the two-sector economy is a closed economy without overseas trade. This implies that all goods are produced by local firms using local resources. Income is firstly circulated in product market when households buy final goods and services from firms. In the factor market, firms use their revenue from sales to purchase factors of production. Then firms flow back income to the households by paying wages, rent, dividends, and profit. Therefore, expenditure on final products is equal to income earned by all factors of production. Based on the two-sector circular flow model, total income is equal to expenditure and is equal to value of final products. Therefore, there are three approaches for calculating national income. These methods include output, expenditure, and income approaches. All of the three approaches should result in the same total amount for economic wealth created in a period, which we call as gross domestic product, or GDP. Output approach is also called as value-added approach. This approach measures GDP by adding net value of all final outputs produced by all productive activities by a nation in a year. Bear in mind, GDP includes only final commodities that are sold to the final users. GDP does not include intermediate goods, self-consumption goods, and non-productive transactions. Intermediate goods are goods that are purchased for resale or further processing. Adding intermediate goods in GDP will create double counting problem. Self-consumption goods are goods that people produce for their own use without traded in market. For example, agricultural outputs consumed directly by farmers without market transaction. Non-productive transactions include transactions that have no contribution to generation of final goods. For example, public transfer payments are welfare payments that government gives to households. However, the recipients contribute nothing to current production. Private transfer payments include money or gift that parents give to children. Stock market transactions such as selling stocks and bonds are not included in GDP calculation. Lastly, second-hand sales such as used cars, jeans, and houses were counted in GDP the year they were produced. This example illustrates the output approach for calculating GDP. Assuming that firm R produces wheat valued at $100. Firm I purchases wheat valued at $100 and produces flour that it sells for $130. Firm A purchases the flour for $130 and uses this flour to produce bread and sells the bread for $180. In this example, Firm R produced $100 of wheat. Firm I added $30 of flour to GDP. Firm F contributed $50 of bread to GDP. Therefore, total contribution to GDP from these three firms is $180. This is another example of using output approach for calculating GDP. Given that Firm A produces the necessary raw materials and sells them for $1,000 to Firm B. Then Firm B manufactures them into finished products and sells them to a retailer, Firm C, for $1,800. Finally, Firm C sells them to households for $2,500. What is the contribution to GDP? The answer is $2,500, as this is the product value that will be paid by the final users. The expenditure approach measures GDP by summing expenditures to purchase goods and services by a country in a year. There are four components of expenditure in an open economy. These include household consumption, investment, government spending, and net exports. Therefore, aggregate expenditures are C plus I plus G plus X minus M. Consumption of households is referred to spending by households on goods and services. However, household expenditure does not include buying residential housing because it is counted in the investment category. Secondly, used goods transactions are not counted as household consumption because they were part of GDP in the period they were first time sold out. Besides that, financial assets such as bonds and stocks have no contribution to generation of final goods. Therefore, transaction of these financial assets is not contributed to GDP. The second component of expenditure GDP is capital investment. This includes expenditures on the production which are not for present consumption. Examples of investments are spending on inventories, business capital goods, and residential housing. Government expenditure is referred to spending on goods and services by local, state, and federal governments. These include expenditures on education, pollution control, salaries of civil servants, and send a rocket to Jupiter. Bear in mind, public transfer payments are not part of expenditure in GDP because recipients of this expenditure do not make in return for currently produced commodities. The fourth component of GDP expenditure is net exports. It is the difference between exports and imports. Exports include all expenditures on domestically produced goods by foreigners. Malaysian export increased when Malaysian firms sell goods to German households. On the other hand, imports mean spending on foreign goods by domestic residents. Malaysian imports increase when a Malaysian buys a car that was made in Japan, or a Malaysian takes a vacation in Italy, or a firm in Malaysia buys raw materials from American firm in the United States. In this example, net export is negative 0.5 trillion. It implies that export is less than import. By using the expenditure approach, GDP is equal to consumption plus investment plus government expenditure plus net exports. Therefore, the answer is 12.1 plus 3 plus 3.2 minus 0.5, which leads to $17.8 trillion. The income approach assumes that GDP is the total of income earned by owners of factors of production. Therefore, GDP is equal to rent for land, wages for labor, interest for capital, and profits to entrepreneurs. In example 3, GDP is equal to 500 plus 100 plus 200, which ended up with total value of $800 million. Nominal GDP is the total values of final products based on price and quantity of products at the time of transaction. Hence, nominal GDP is the sum of current year price multiplies current year quantity of each product. On the other hand, real GDP is total final product values by using base year price and quantity produced in the current year. Therefore, real GDP is the sum of base year price multiplies current year quantity of each product. In this example, we have to assume that an economy produces two products only, which are apple and orange. According to the question, 2015 is a base year or reference year. 2016 is the current year or calculated year. In part 1 of the question, nominal GDP of the economy in 2016 is the total value of apples and oranges produced in 2016. Therefore, prices and quantities of 2016 should be used to calculate GDP. In part 2, real GDP is calculated based on 2015 prices and 2016 quantities. In part 1 of this example, nominal GDP in 2015 is using 2015 prices and quantities to calculate final production value of this island. In this chapter, we have learned the difference between microeconomics and macroeconomics. One of the major studies in macroeconomics is national income. One of the measurements to calculate national income is GDP. The higher the GDP, the more wealthy is the country. There are three methods to calculate GDP, namely production approach, expenditure approach, and income approach. For production approach, GDP is equal to net value of all final goods. For expenditure approach, GDP is household consumption plus investment plus government spending plus export minus import. For income approach, GDP is sum of rent, wage, interest, and profit. Lastly, real GDP is using base year prices to calculate total value of final goods produced by a country in a year.